Here are the types of tradition that change the parent company church interest in the subsidiary.
A partial acquisition of a business occurs when a company obtains control through the acquisition of less than 100% of the equity interest of an entity. Step acquisitions occur when a company acquires equity interest in a business over a period of time in a series of transactions through which the company eventually obtains control of the business. When a company obtains additional interest in a business or sells a portion of its interest in a business, the accounting results vary depending upon whether the company continues to control the business. A parent's ownership interest in a subsidiary might change while the parent retains control, including when a parent purchases additional interest in a subsidiary or the subsidiary reacquires some of its shares, thereby increasing the parent's ownership interest in the subsidiary. Loss of control by a parent may occur in different ways, including when a parent sells all or part of its interest in its subsidiary. A contractual agreement that gave control the subsidiary to the parent expires. Control is obtained by another party through a contract. The subsidiary issues shares, thereby reducing the parent's ownership in the subsidiary, or the subsidiary becomes subject to the control of a government, court, administration, or regulator.
Company buy or establish a subsidiary to provide the parents with specific synergies such as increased tax benefits, diversified dress or access, and a form of earning equipment or property.
The purchase usually costs the parent corporation a smaller investment, as shareholder approval is not required to turn a company into a subsidiary as it would be in the event of a merge, nor is a vote required to sell the subsidiary. The parent company has controlling interest of 50 to less than 100% in subsidiary and reports financially result of the subsidiary consolidated with its own financial statement. The minority interest can be found in the non-current liability section of equity section of the parent company's balance sheet under the General Accepted Accounting Principle GAAP rules. On its financial statement, Company A cannot claim the entire value of Company B without accounting for the 25% that belong to the minority shareholders of Company B. Thus, Company B's minority interest of its balance sheet and income.
The effect of eliminating process when the subsidiary issues new share entirely to the parent, the ownership interest is effectively decreases.
The parents report the difference between selling price and book value. When shares are sold subsequent acquisition through parent sales that all shares owned, loss of control but maintains control, gain or loss and difference between selling price and book value. The entire interest must be adjusted to fair value and gain or loss recorded on all shares owned prior to sale. An adjustment, there is no gain or loss reported on the income statement nor evaluation required. The impact on the parent's investment account when the new shares are purchased suitably by the parent and non-controlling shareholders or the entire by the non-controlling shareholders is that the parent's ownership decreases, there is no participation by the non-controlling interest. No loss of control. If the parent's ownership is increases, there is no also participation by the non-controlling interest. No loss of control. Adjustment to contributed capital of controlling interest, there is no revaluation required. parent company can effectively increase ownership interest in a subsidiary, either buying or additional subsidiary shares directly from the third parties or having subsidiary purchase. That's all, sir. Thank you.